You shouldn't buy a house before checking the foundation. You shouldn't buy a car before checking the engine. So why are you buying crypto before checking the tokenomics? Today, we're learning how to read the blueprint of digital assets. Welcome back to Unwrapped, your deep dive into DeFi, NFTs, on-chain culture, and all things in the BMX ecosystem. And today, we're going back to basics. We're tackling the single most important word in crypto, tokenomics. It's a mashup of token and economics. Put simply, it's a set of rules that determines if a cryptocurrency is designed to gain value or on a slow downward spiral to zero. If you've ever wondered why a coin with a 1 cent price tag isn't actually cheap, or why projects with a crazy high APY are flash in the pans, the answer is usually tokenomics. By the end of this video, you'll be able to look at any project and spot some of the common red flags that 99% of people miss. And then we'll finish by looking at how the BMX token was designed to solve some of the biggest problems in this field. And as always, just a quick reminder, this is for educational purposes only. It is not financial advice. Let's start with the first pillars of tokenomics: supply and market cap. The most common mistake that beginners make when deciding which crypto is quote-unquote affordable is looking at the price of a token. Oh, look, this coin is only 1 penny. And if it goes to $1,
I'll be a millionaire.
This is a trap. And to understand why, you have to understand that price is meaningless without understanding supply. Think of a project's value like a giant gold bar worth exactly $100 million. Crypto project A is that solid giant gold bar. As a whole, it costs $100 million. The supply here is 1. It's expensive because there's only 1 of them. Crypto project B is also just like that giant gold bar. And as a whole, it costs $100 million. But this bar was cut into 100 million pieces. Here, the supply is 100 million, which means the price of each token is $1. Crypto project C is once again that same giant gold bar worth $100 million, but we've ground it down to 10 billion tiny gold specks of dust. Here, the supply is 1 billion, which means the price of each speck, or the price of each token, is 1 cent. So, token C, each one costs 1 cent. A beginner who hasn't watched this video looks at the spec and says, wow, it's so cheap. I'll just buy 1 million specs, and when the token price reaches $1, I'll be a millionaire. But let's do that math. For that tiny speck to reach $1, the total value of that giant gold bar, or the market cap, would have to go from $100 million to $10 billion. That means this gold bar, or crypto project C, would have to become as valuable as a Fortune 500 company just for a tiny speck of dust to reach $1. It would have to become one of the most valuable crypto assets. So what's the lesson? Well, you aren't getting a deal on the price. You're just buying a smaller slice of that same bar. So how do you spot the real value? You ignore the price and you look at the market cap. So how do we find the market cap? Easy. You can just visit CoinGecko.com, and by default, all the crypto assets there are sorted by market cap. Or you do a simple calculation. Current price times circulating supply, which we'll cover soon, equals the market cap. And the market cap tells you what the whole gold bar is worth, not just the dust. But there is a hidden danger here. You also need to look at what's called the FDV, or fully diluted valuation. This is the value of the project if all the tokens that will ever exist were sold today. And now, a red flag. If you see a project with a market cap of, let's say, $1 million, but the FDV is $100 million, that's a massive warning sign, because it means that 99% of tokens are waiting on the sidelines, ready to flood the market and dilute its value. Inflation and emissions. This leads us to the second pillar, inflation, also known as emissions. In the real world, governments print money. When they print too much, your dollar is worth less. This is inflation. Think of it this way. In 1970, a cup of coffee cost 25 cents. Today, that same cup of coffee costs $3. Did the coffee get 12 times better? No. The coffee pretty much stayed the same. Your money just got weaker. And then crypto, projects simulate this by creating or printing tokens to reward people. If you stake your tokens and get over 100% APY, well, you should probably look into where those rewards are coming from. It's not magic money. Usually, it's inflation. The protocol might be printing more tokens to reward you. The lockup trap. Now, here's where it gets a little tricky. Some protocols know that inflation kills their token value, so they try to hide it. They tell you to lock up your tokens for a period of time, and they'll give you massive rewards. That sounds great, but it's often just a disguise, because they're printing millions of tokens while asking you to lock them up so that you don't sell them. It keeps the price stable for a while, but eventually, those lockups will expire. It's like sweeping dirt under the rug. Eventually, the rug will get too lumpy and everyone will trip over it. And when those tokens finally unlock, the inflation dam breaks, and the value often collapses. So the lesson? High APY sometimes means high inflation. If the token supply is doubling every year, that means the demand needs to double just to keep the token price the same. And that's why a zero emissions model, where a project is literally unable to print new tokens, is becoming the new standard. Because if the token printer was intentionally broken, that token value can't be inflated away. Allocation and vesting. Let's talk about allocation. Who actually owns the tokens? When a new project launches, look at the pie chart in their white paper. How much did the team get? How much did the early VC investors get? How much was sold to the public? If the team and investors own 50% of the supply, that's a lot of power. If they sell in large amounts, the price can crash. And this is why you need to check the vesting schedule. Think of vesting as sort of a trust fund. Imagine a wealthy kid turns 18. He has $10 million in his name, but the rules of the trust fund says he can't access the entire $10 million today. Instead, he gets access to $1 million a year for the next 10 years. This is a vesting schedule. It forces a team and investors to stay committed for the long term. And here's a couple of key words to be aware of. Cliff. A cliff means they get nothing for a set of time, usually around a year or so. Linear vesting. Linear vesting means they get a small amount every month after the cliff ends. And here's a red flag to keep in mind. If a project has a very short vest, be careful. They might be planning to sell their tokens the moment the price goes up. So again, please be careful. Utility. Okay, so we've covered supply, market cap, price, inflation, and allocation. But none of that matters if nobody wants the token. Tokenomics is just supply and demand. We've talked about supply. Utility is what drives the demand. So we have to find out why this token exists. So let's cover some of the common use cases for a token. Gas. You need ETH to use Ethereum. You need Sol to use Solana. This is one of the strongest utilities because you have to buy the token to use the network. Governance. With governance, you hold a token to vote on changes. For example, with BMX, holders of the token get to vote on change proposals, such as changes to how fees are routed throughout the ecosystem. Real value. So this is the holy grail. This means that holding the token earns you a portion of the protocol's value, not in printed tokens, but in solid assets like ETH or USDC. If a token has no utility, it's just a meme coin with no meme, and that's fine so long as you know you're gambling on popularity, not on fundamentals. Before we break down the ideal tokenomics model, a quick word about the ecosystem that makes this show possible, BMX. We've been talking about utility and real value, and that isn't just a theory we cover. It's the philosophy behind our flagship product, Deli Swap. You see a lot of DEXs have poor tokenomics designed right into the product. They try to trap you. They force your trades through their own platform just to collect a fee, even if that means giving you a bad price. And Deli Swap takes the opposite approach. It's a meta aggregator. It scans every single route on the base ecosystem for you. If another DEX has a better price, Deli Swap routes your trade through that DEX automatically, even if it means forfeiting the fee. Because it's not about protocol profit. It's about giving you the fairest execution every time. And for liquidity providers, it's the ultimate real value utility. Instead of pairing with the naked inflationary token, you pair with WBLT. That means your liquidity is instantly backed by Bitcoin, Ethereum, and USDC, and you earn fees from the entire BMX ecosystem. Swaps, perps, intents, NFTs, fees from all on-chain activity, all in one position. One position, 3 blue chips, more ways to earn. So stop guessing which DEX will give you the best price, because the Deli is open. Now, let's see how we apply that same real value philosophy to our own token, the real value evolution. So what does good tokenomics look like today? We'll use the BMX token as our case study, because when we designed this, we looked at the failures of the past, the infinite printers, the hidden unlocks, and we did the exact opposite. So here's the BMX tokenomics blueprint. 0 emissions. Remember how we talked about inflation making your digital assets weaker? Well, BMX has 0 emissions, but we went a step further. We didn't just stop the printer, we destroyed it. The minting contract is burned. That means there will never be more BMX than there are today. In fact, all tokens are currently in full circulation. There are no hidden supplies waiting to unlock. What you see is what you get. Real value. So if we don't print tokens, how do we reward BMX stakers? We capture real value. You see, BMX is an ecosystem of products. And every time someone trades or swaps or buys an NFT, they're paying a small fee. And all those small fees are collected, and a portion are routed to BMX stakers in the form of Wrapped ETH, which is a token that holds the same value as Ethereum. If you stake your BMX, you don't earn more BMX. You earn a stream of Wrapped ETH derived from all those platform fees. It's about capturing and distributing real value, pure and simple. Multiplier points. We also wanted to solve the mercenary problem. We didn't want people hopping in for a week and leaving. So we created multiplier points. When you stake BMX, you earn multiplier points. These aren't tokens you can sell. Think of them like on-chain loyalty points that boost your share of the Wrapped ETH rewards. But here's the catch. If you unstake your BMX, your multiplier points are burned. And this aligns the incentives. So the longer you stay, the higher your portion of the value captured by the ecosystem. It rewards the long-term holders. Fee backing. On Deli Swap, our decentralized exchange, 97% of the trading fees are used to buy back BMX from the open market and distribute it to liquidity providers. This creates constant organic buy pressure for the token, fueled by actual usage of the platform. The tokenomics cheat sheet. All right, before we go, here's your tokenomics cheat sheet. If you keep these in mind, you'll be way ahead of 99% of everyone else. Price. Price is the cost of one token. It's meaningless without knowing the supply behind it. Circulating supply. Circulating supply is the number of tokens actually available on the market today. This excludes locked, vested, or unreleased tokens. Total supply. Total supply is the total number of tokens that will ever exist. And this includes locked, vested, or unreleased tokens. Market cap. The market cap is the price of all tokens available today. FDV. FDV is the price of all the tokens that will ever exist combined, not just the tokens available today. A bit of a cheat code. If FDV is way higher than market cap, be careful, because this means a massive dilution is coming later. Inflationary value. Now let's talk about real value versus inflationary value. Real value comes from on-chain activity. This is a key ingredient to a sustainable project. Inflationary value comes from printing new tokens, which devalues the token. Cliff. A cliff is a waiting period where the team or investors get 0 tokens. Vesting. Vesting is the schedule for releasing tokens after that cliff ends. And the cheat code here, look for long cliffs, about 1 or more years, to ensure the team is committed. And finally, utility. Utility is what the token actually does. Tokenomics is the blueprint of value. It tells you if a project is a get-rich-quick scheme for the founders or a sustainable economy built for the users. The old model was print tokens, inflate the supply, and hope new people keep buying. The new model is provide a service, capture value, and share that real value with users of the ecosystem, and ideally with 0 emissions or tokenomics gimmicks. So the next time you look at a new crypto project, don't just look at the price, look at the supply, look at the market cap, check if the minting contract was burned. Ask yourself, where does the value come from? If the answer is a printer, be careful. If the answer is real value from on-chain activity, you may have found something pretty special. Thanks for watching this episode of Unwrapped. If you found this breakdown helpful, hit the subscribe button and check out the other deep dives and our conversations with builders in the crypto space. Class is dismissed, and I'll see you on the next one.